Good morning. Welcome to your daily morning digest for Thursday, February 12, 2026. I'm here with your 15-minute briefing on markets, crypto, global events, and life wisdom to power your day. Let's dive right in. Starting with crypto news, Bitfury founder Val Vavilov is doubling down on Bitcoin despite recent volatility. The cryptocurrency billionaire says the recent price drop is a golden opportunity to buy at what he calls a low price. For context, Bitcoin has had a turbulent start to 2026, at one point tumbling to its lowest level in over a year, wiping out gains made since President Trump's return to office. Some reports suggest Bitcoin saw a 50% plunge from its recent peaks. Vavilov, an early cryptocurrency adopter who built Bitfury into one of the industry's biggest players over 15 years, is using this moment to rebalance his portfolio. In WhatsApp comments, he said, "For us, the fall in Bitcoin is an opportunity to rebalance our portfolio and purchase a certain amount of Bitcoin at a low price," though he didn't reveal specific purchase amounts. This is classic contrarian investing from someone who's been in the space long enough to see multiple cycles. When others panic, the veterans buy. It's a reminder that in crypto, volatility cuts both ways, and seasoned investors often see crashes as buying opportunities rather than exit signs. Staying in crypto, we're seeing institutional money make a strategic move into Solana's decentralized finance ecosystem. Fasanara Digital, an institutional allocator, has deployed capital to Solstice's Yield Vault, the protocol's flagship delta-neutral yield strategy on Solana. This announcement came out of Zug, Switzerland on February 11th. What makes this interesting is the institutional validation of Solana's DeFi infrastructure. Delta-neutral strategies are designed to capture yield while hedging out directional market risk, exactly the kind of sophisticated approach institutions demand. We're watching a trend here. As crypto matures, institutional players aren't just buying and holding Bitcoin anymore. They're getting sophisticated, deploying capital into yield-generating DeFi protocols on chains like Solana. This signals growing confidence in Solana's infrastructure and the maturity of its DeFi ecosystem. When serious institutional money starts flowing into yield products, it suggests the market is moving beyond speculation into actual utility and income generation. Shifting to commodities, oil prices rose more than 1% after reports emerged that the United States is preparing to deploy a second aircraft carrier to the Middle East amid escalating tensions with Iran. President Trump mentioned Tuesday that he's considering sending additional naval assets to the region as diplomatic tensions continue. According to UBS oil analyst Giovanni Stornovo, ongoing tensions in the Middle East continue to support prices, although so far there has been no supply disruption. That's the key point here. We're seeing a risk premium being priced into oil, not an actual supply shock. The market is pricing in the possibility of future disruption. Earlier this month, the US shot down an Iranian drone that was approaching an aircraft carrier, which sent oil futures up more than $1 per barrel. The situation remains tense, but what's interesting is how quickly the market reacts to geopolitical signals even before any actual supply impact occurs. This is exactly why traders pay such close attention to Middle East developments. The region's stability has immediate implications for global energy markets. Precious metals are also reacting to these geopolitical tensions. Gold and silver prices rose following the same US-Iran tensions, combined with strong January payrolls data. We're seeing classic safe haven buying behavior here. When uncertainty rises, investors flee to traditional stores of value like gold and silver. According to Reuters, gold rebounded and was set for a weekly gain, helped by bargain hunting, a slightly weaker dollar, and lingering concerns over US-Iran talks in Oman. Silver also recovered from a 1.5-month low. The interplay here is fascinating. We have geopolitical risk driving safe haven flows, a softer dollar making metals more attractive to foreign buyers, and strong economic data that might normally hurt gold instead being overshadowed by uncertainty. Gold and silver often move together, but silver has more industrial demand, so when both are rising, it tells you investors are genuinely worried about broader risks, not just hedging inflation. Moving to the streaming wars, Netflix is showing how a mature tech company pivots from growth at all costs to disciplined profitability. The streaming giant has shifted its strategy from purely chasing subscriber numbers to focusing on monetization efficiency and margin expansion. Here's what that looks like in numbers. Netflix's operating income reached roughly $13 billion over the last 12 months, with margins expanding to about 29%. That's impressive profitability for a content-heavy business. The company achieved this through disciplined content spending, no more throwing money at every project, and growing contributions from advertising and licensing revenue. The ad-supported tier is now proving monetization, not just scale. Execution becomes critical as Netflix juggles expansion into new markets while maintaining profitability. This is a case study in business model evolution. Netflix went from DVD rentals to streaming pioneer to growth-obsessed disruptor to now, finally, a mature profitable media company. The shift from subscriber growth at any cost to how much money can we make per subscriber is exactly what investors want to see as a company matures. It's working. Some analysts believe Netflix could hit all-time highs in 2026 if they continue executing on this strategy. On the fiscal front, the U.S. federal budget deficit showed some improvement, but not enough to meet expectations. According to the Congressional Budget Office, the January deficit came in at $94 billion. The cumulative deficit for the first 4 months of fiscal year 2026 totaled $696 billion, that's 19% lower than the same time last year after adjusting for timing effects. However, CBO forecasts show the deficit will continue growing in the years ahead despite some discretionary spending cuts. They project about a $16 billion reduction in discretionary spending for fiscal 2026 compared to their January 2025 forecast, rising to roughly $139 billion by fiscal 2035. But with Trump's tax cuts and tariff policies in play, the overall deficit trajectory remains concerning. Revenue gains from the strong economy are being outpaced by spending increases and tax policy changes. The bottom line, yes, we're seeing some improvement in monthly deficit figures, but the long-term fiscal picture remains challenging. This matters because sustained large deficits eventually affect interest rates, borrowing costs, and ultimately economic growth. Now let's shift to global news and sports. The 2026 Winter Olympics are in full swing in Milan and Cortina, Italy, running from February 6th through the 22nd, and we're already seeing history being made. Italian short-track speed skating legend Oriana Fontana just extended her own record as the most decorated short-track speed skater of all time. On Tuesday, February 10th, she won her 12th Olympic medal, a gold in the mixed team relay, at her 6th Winter Games. 12 medals across 6 Olympic Games is extraordinary consistency and longevity at the highest level of competition. She now has 3 gold medals from these Olympics alone. Meanwhile, in figure skating, all eyes are on Ilya Malinin, who is the only person in the world capable of landing a quad axel, one of the sport's most difficult jumps. He's the overwhelming favorite for men's gold. And in ski jumping, we saw a heartwarming sibling story as Slovenia's Nika Prevc and Domen Prev both won gold in the mixed team event. There's something special about Winter Olympics, the combination of extreme skill, danger, and the pure artistry of sports like figure skating and freestyle skiing. If you haven't been following, now's a great time to tune in. We're at the midpoint of the games, and the competition is heating up. And our final news story takes us into cutting-edge science. Stanford researchers just announced a major breakthrough that could help quantum computers finally scale up to practical use. On February 2nd, they revealed they've created miniature optical cavities that efficiently collect light from individual atoms. Here's why this matters. One of the biggest challenges in quantum computing is reading information from qubits, the quantum bits that make these computers so powerful. Current methods can typically only read 1 or a few qubits at a time, which limits scalability. Stanford's breakthrough allows many qubits to be read simultaneously by using light-based detection. Think of it like this: if you're trying to read a book but can only look at one letter at a time versus reading whole sentences at once, you can imagine how much faster the second approaches. Quantum computers promise to solve problems that are impossible for classical computers, from drug discovery to cryptography to climate modeling. But they've been stuck in the lab because scaling them up has been so difficult. This light-based approach could be a critical piece of the puzzle. We're still years away from quantum computers in your pocket, but breakthroughs like this move us from if to when. And given the potential applications in medicine, materials science, and AI, that's genuinely exciting news for humanity's technological future. And now, let's shift gears to today's Life Wisdom segment. Today's insight comes from Morgan Housel's The Psychology of Money, and it's a powerful reframe on what wealth actually means. The key idea is this: true wealth is the money you don't spend. We live in a world obsessed with visible symbols of success. The luxury car, the designer watch, the expensive house, the exotic vacation photos on social media. We see these things and think that person is wealthy. But Housel argues that's actually backwards. Those visible purchases might indicate high income, but they don't necessarily indicate wealth. In fact, they might indicate the opposite. There's a crucial distinction between being rich and being wealthy. Being rich means having a high income, you earn a lot of money. Being wealthy means having financial freedom, you've accumulated assets that give you options and security. You can be rich but not wealthy if you spend everything you earn, no matter how high your income is. And you can be wealthy without appearing rich if you've saved and invested wisely while living below your means. True wealth is invisible. It's the savings account you never talk about. It's the investments quietly compounding in the background. It's the ability to say no to work you don't want to do. It's the option to take 6 months off if you need to. It's the peace of mind knowing you could handle an emergency without panic. None of these things are visible to your neighbors or Instagram followers, but they're what actually matter. The irony is that building real wealth often requires doing the exact opposite of what signals wealth to others. It requires driving a modest car when you could afford a luxury one. It requires living in a smaller house than you qualify for. It requires choosing the regular clothes instead of designer brands. It requires restraint, patience, and a willingness to be misunderstood by people who judge success by appearances. This is psychologically difficult because humans are social creatures. We're wired to care about status and to signal our success to others. The problem is that these signals, the visible consumption, actively work against building real wealth. Every dollar spent on impressing others is a dollar not working for your future freedom. Housel points out that the best financial decision is often invisible to everyone except you. Maxing out your retirement contributions doesn't show up at parties. Keeping 3 months of expenses in emergency savings doesn't get likes on social media. Choosing index funds over individual stock picks doesn't make for interesting conversation. But these boring, invisible choices are what create actual financial security. There's also a compounding effect here. The person who buys the luxury car not only spends the purchase price, they also lose the investment returns that money could have generated over decades. If you invest $80,000 instead of spending it on a car, and that money compounds at 8% annually for 30 years, you're looking at over $800,000. That's the real cost of visible consumption, not just the price tag, but the opportunity cost of what that money could have become. So what's the practical application? Start by auditing your spending through this lens. Which purchases are actually adding value to your life, and which are primarily about signaling status to others? Be honest with yourself. That doesn't mean never spending on things you enjoy, it means being intentional about the difference between spending that brings genuine satisfaction and spending that's really about impression management. Second, redefine success in your own mind. If your metric for success is what others can see, the house, the car, the clothes, you'll always be tempted to spend on those visible markers. But if you define success as financial freedom, options, and security, suddenly the invisible accumulation of savings and investments becomes your scorecard. You start to feel proud of the growing net worth that nobody sees, rather than the depreciating purchases that everybody notices. Third, find a peer group that shares these values. It's much easier to live below your means when your friends aren't constantly upgrading their lifestyles. Surround yourself with people who value financial independence over conspicuous consumption, and the social pressure works in your favor instead of against you. The ultimate goal here is to reach a point where you have what Housel calls FU money, not in an aggressive sense, but in the sense of having enough wealth accumulated that you don't have to take jobs you hate, tolerate situations that drain you, or make decisions purely out of financial desperation. That's real wealth. That's real freedom. And it's completely invisible from the outside. Remember, the person driving the modest car might be a millionaire building wealth. The person driving the luxury car might be drowning in debt maintaining an image. You can't tell wealth by looking at someone's lifestyle, often it's the opposite. The millionaire next door looks like the middle-class neighbor because that's how they became a millionaire. So as you go about your day-to-day, think about this distinction. Are your financial decisions building real wealth, the invisible kind that creates freedom and options? Or are they building the appearance of wealth, the visible kind that impresses others but traps you financially? The choice you make on this question will shape the trajectory of your entire financial life. That's it for today's Morning Digest. Thanks for spending these 15 minutes with me. I hope you found something valuable in today's mix of market news, global events, and life wisdom. Whatever you're working on today, I hope you're building something real, whether that's a project, a relationship, or yes, invisible wealth. Have a great Thursday, and I'll be back tomorrow with more insights to fuel your morning.